Hello and good morning, listeners. This is Almus Market Mornings with Shikhar Garg bringing in the global financial updates. Geopolitics, which was seating in the background for a while, thought of coming in the driving seat. Yesterday, in an address, Vladimir Putin said Russia will be suspending the last accord with US, which was limiting the nuclear arsenal. Basically, US is losing their access to inspect and monitor the nuclear arsenal by Russia. Now, this has somewhat triggered a risk of sentiments driving a lot of stocks lower and the yields higher. Apart from geopolitics, Japanese central bank announced an emergency bond buying program to contain the elevating yields beyond the policy range. Eurozone, on the other hand, released some good data, PMI data, giving signs of an accelerating recovery. So, JK, there's kind of a mixed bag with Japanese central bank still wanting to, contain the yields, Eurozone recovery accelerating, but geopolitics burning its head out. What's your take?
Yeah, good morning. I think geopolitics is definitely on the front line of news, and Putin's statements yesterday in the much-awaited speech was mostly directed towards blaming the West and the NATO for turning a local conflict into a global war. But its declaration of suspension of Russia's participation in the New START treaty, which is the arms deterrent treaty, and also putting new ground-based strategic complexes on combat standby duty. These are the things that send jitters across geopolitical observers. And the treaty was one which was signed in 2010 to prevent a nuclear war, and it limits the number of strategic nuclear warheads that both sides can deploy and give each other country the power to inspect. Putin warned that Russia was ready to resume nuclear weapons testing. So some experts opine that with this development, we are witnessing a real threat of a nuclear war. While it may or it may not be, it is indeed seen as a very serious development as it raises the specter of arms race once again. On the other side, while being blamed by West for supplying arms to Russia, China added its own bit to the geopolitical jitters by saying it's deeply worried about the escalation of the conflict and the possibility of the situation spiraling out of control, urging certain countries to immediately stop fueling the fire. And in another development, US plans to impose new sanctions on some 200 Russian individuals, entities, as per Wall Street Journal. So reports of China President Jinping is also preparing to visit Moscow for a summit with the Russian president in the coming months, even as West remains skeptical that it wants to play a more active role aimed at ending the Russia-Ukraine conflict. So it was all building up into a definite risk of sentiment. Then came the good news, which was taken as a bad news. UK PMI and Eurozone PMI both beat expectations, both surging into the expansion territory above 50 and pushed up the yields in UK and Europe, to almost at the recent highs. And in UK, there was further good news, rather, that they posted a surplus budget for the month of January, and that gives a wriggle room for Mr. Hunt to explore tax cuts or spending increase when he makes a budget statement next month. So all of this actually pushed up the yields in Europe, and it was followed by the US session, where again data on PMI was very strong from the US economy on the services sector, making up a lot for the downtrend in the manufacturing sector. So once again, we saw yields move up in the US session as well. Then there was the rise in the yields and expectation of higher interest rates has pushed down most of the FANG stocks. Then credit default swaps on Credit Suisse, the Swiss bank under watch of the investors, rose as much as 17 basis points from its Monday close. I think one more statement which probably did not get much attention was the Fitch not seeing as strong a rebound in China's growth as in 2021, because the tighter global monetary policy will weigh on demand for Chinese exports. So we have a host of factors which kept the stocks really on the defensive, and definitely having seen a strong rally from January, now we are into a deeper correction mode for the stocks. I think there is some more downside left until we get indications that Fed maybe closing to the top, but we really have to wait for more clues on that. FOMC minutes tonight and GDP tomorrow, PCE core inflation on Friday. These are things that will keep traders on the edge of their seats. Japan's 10-year JGB yields were trading above 0.5 since yesterday afternoon, but central bank has swung into action by announcing emergency bond buying operations, and another official said that widening of yield band in December was not aimed at tightening the monetary policy, pouring cold water on speculators who thought that Ueda might just announce something on the tightening side. The Reserve Bank of New Zealand set the ball rolling for the next round of rate hikes by raising official cash rate by 50 basis points to 4.75%, its highest level since late 2008, and also remained hawkish in their statements. So it was a time when bonds and stocks fell together after flirting for a trial, of separation earlier this month, when equities actually resisted a sell-off and hit only the fixed income securities. The steady drumbeat of hawkish rhetoric from policymakers has persuaded investors that central bank means business when they say they will take interest rates higher than expected and potentially keep them for long. And while the government debt has been sold off for long, equities and probably took some heart from some better earnings reports. And then yesterday it all came loose, and we saw both the bonds and stocks taking a hit. The major indices in the US were down more than 2%. Global Composite Index was nearly down 1.75%, carried into the Asian session as well. Dollar not so strong despite such a big risk of situation, as because of other economies also being strong, rates going higher in other countries as well. Lagarde keeping the sentiment on euro hawkish, saying that they will move towards a 2% inflation targets, and New Zealand policy rate rising, and Japan possibly on the cusp of a policy shift, although short term they are trying to control it. I think all these things kept the dollar not so strong, which normally we would have seen in a situation where geopolitics is in a nervous state, and also on the stocks falling and yields rising. So basically, we'll wait how these things move forward on the geopolitics, as well as in the most important economic data from US in the coming days as well. On the USD-INR, yes, we have been seeing a narrow range trading almost every day now. The ranges are getting narrower. Importantly, what I observed was the implied volatility on 6-month benchmark options have narrowed down to its lower end of the range, near 5.25%. And historically, we have seen that from this range, it usually takes off. And whenever it takes off, we see volatility in the rupee returning. We still don't have a signal that it's happening, but move above 5.5% could be a signal that people are buying more protection against rupee volatility. And usually the volatility is on the higher side for the USD-INR, but we just keep observing this. And I'm also leaving with one more point. It's worth noting that real effective exchange rate of the rupee is now below 100, and it's at 99. And this was seen last in 2018-19. And whenever it goes below there, stays for a couple of months or maybe 3-4 months, and then it bounces. So when it bounces, it means that the rupee improves in its value. Right now, it is undervalued at 99. So we do not know what factors will come into play right now, what can be the trigger going forward, but we keep observing the RER also very closely. Thank you.
Okay, JK, that's quite interesting. And RER below 100, folks, that as JK mentioned, says that the Indian rupee is undervalued and there's some scope for the rupee appreciation that can follow through in the coming months. The reasons behind that are yet to be seen, and it will be quite interesting to watch the markets develop in that particular manner. But what we are seeing is geopolitics is definitely in the forefront, as the suspension of the new arms limitation treaty was taken as a threat by almost all market participants across. One of the reasons for the yields to start rising again, apart from the higher PMI data released by all of them, almost Euro, UK, US, all of them, which actually put the higher terminal rate expectations also in the focus. So it's a lot of activity on the geopolitics and the economic data releases, which has put the contention that the rates will continue to stay higher and the uncertainty will continue, which has put the pressure on the equities on the lower side as well. Now, the good news taken as the bad news was an interesting aspect to look at the recovery in the Eurozone economy. But what is to be seen is the low volatility in the Indian markets. Now, that's something which can, put everyone in the caution side, as a prolonged low volatility will eventually lead to an increased volatility. So, folks, I hope you guys are prepared for the things to come ahead in the next few days. We already have an action-packed second half of the week starting from tomorrow. We'll see how things go about. That's it for today, folks. Thank you so much for listening.